Let's talk about the big picture on what equities need next after the stimulus deal finally comes to fruition. Tony Dwyer is joining us, Chief Market Strategist at Canaccord Genuity, on the phone today. So, Tony, let's talk about some short and intermediate term stuff first here this morning. Equities pulling back a little bit. I look at your note and you say this is a market that looks ripe for either news that is going to surprise us, consolidation, maybe correction. So walk me through this maybe cautionary short-term call.
Well, actually, Oliver, thanks for having me, and happy holidays for everybody. It's been a short-term call that's been in place for about a month now for us. And if you actually look at the percentage of stocks in the S&P 500 that are trading above their 10-day moving average, that number has dropped from over 90% a month ago to currently, I don't know exactly what it is yet this morning, but it was 50% as of last Friday, so it's worse this morning. So the market's been consolidating underneath the surface, and there's been a significant chase for the areas that that we've liked, which is the small cap, the cyclicals, the emerging. The global recovery theme has been in play, and it just got a little bit excessive. So our shorter-term stuff has been pulling back. Volatility's having a little bit of a bump, but the intermediate-term stuff has a little bit more room to go.
So, Tony, what is there a reason, a rhyme, a cause? Because I would imagine that just after a really hot period of gains, you could have something like you're describing without any real cause for longer-term concern. Is there a particular news story or something that could be a longer-term cause for concern, Tony? I mean, or is this market basically just going to trend higher once this kind of period is over?
Oliver, you've been doing this a while. People like me always come on TV and they try and pretend that they know what the reason for the correction is going to be, and you never know. It's sort of like trying to figure out a multiple expansion. It's just you only have to answer the question: is an environment ripe for a multiple expansion? And in this situation, is the environment ripe for an out of nowhere news item? You never know what's going to create the correction; otherwise, it would be priced in. So in this situation, until this weekend, nobody really had a fear of another strain of the COVID-19 virus. And all of a sudden, with a UK shutdown, it is on top of an already a historically overbought and historically optimistic market. It was ready for a news item, and unfortunately, for all of us, it's this one.
Tony, the news item is definitely showing up in some of the travel stocks. This morning also, though, since the open, the Nasdaq's now in line with the Russell, actually a little bit lower than the Russell. I'm curious what you think the market's reaction to the stimulus news coming to fruition, this $900 billion deal. It's kind of hard because we've got this other complicated news story and to kind of mess up the short-term narrative, but is there profit taking here around stimulus? And if we're not getting any more stimulus until the new administration, what does that mean for markets?
I think it only lasts 11 weeks, the 11-week extra unemployment benefit. It only goes for 11 weeks. So that's not going to carry you until the summertime when most people are vaccinated. So you're going to need another stimulus package, and I think everybody's aware of that. But again, this is one of those news items that you can't really predict nor price in. So that's the problem, Oliver, is this profit taking on the actual news of the stimulus package? No, I don't think so. And you had two good news items coming out of Friday, right? You had not only the likelihood of a stimulus package by the end of the weekend, but you also had the Fed open up the opportunity for some of the larger cap banks to buy back their stock for the first time since the pandemic began. So those two things have been overshadowed by fear of a new strain of the COVID-19 and then that impact on economic activity. So again, it sounds repetitive. It is repetitive. It was a market that was ready for a news item because of the overbought condition and euphoria among investors, and it met this one.
Tony, what if we end the day with the Nasdaq, which has been the home of the quarantine trade, the stimulus trade? What if we end the day with the Nasdaq below the small cap Russell, the reopening trade? Would that mean we have to think about profit taking after the stimulus? I mean, the Nasdaq should be the place that people are running to today, but I already see Zoom, I see Peloton fading pretty hard. Well,
it's a discovered area, Oliver. So, the rotation into that area may not be as dramatic as it was into the stay-at-home stocks when this whole thing began because, yes, there's a new strain and it's creating this incredible fear, but from what I understand, the vaccine still works. So we still have the vaccine in front of us. Remember, the last time that you got this incredible outperformance to stay at home, it was because there was no end in sight. We had no idea when a vaccine would come. Now we have some kind of timeline where this whole pandemic should be able to end. So the fear has created the pullback, and I think that the vaccines coupled with, as you know, my main macro theme is we have historic excess liquidity and a synchronized global recovery. Now, it's getting a little stall here with this waiting for the vaccine to come out, but clearly you have a problem in the market and you have a problem in the economy, Oliver, when you have a need for money and no access to money or limited access to money. As you know, the opposite is true today. So the fear of the new strain pulls it in from an overbought condition. In our view, that creates an opportunity to go after those areas we like once they see profit taking, those being the reopening trade.
Okay, and here's the chart we're looking at. I know that is one of the most important charts to you. The excess is, quote, excess liquidity that is in the system right now. Tony, we heard from the Fed most recently that they're not going to change that. They're not going to add anything to it. I'm curious what you think the role of the Fed is going to be for the market valuation. And just the context here is when you were on a couple months ago, you rightly said that the peak in the Nasdaq was not going to be in September, and the Nasdaq has indeed made new highs. What's interesting is that even over that period, Nasdaq priced new highs. You probably know what I'm going to say here. Valuations are still lower, and the chart of valuations is still fairly meaningfully below where it was in September. Does that limit the upside momentum and the speed of our climb in the market, Tony, if Nasdaq valuations are gradually getting smaller?
No, I don't think so, Oliver. I think so. If you look back, a lot of that excess liquidity chart that you had up, what you'll notice is in that chart, it's similar to the extraordinary excess liquidity you had coming out of the great financial crisis in 2009. And then what happened was you had such a market surge, honestly, a very similar surge to now. You had such a market surge coming off that March 2009 low that it got ahead of where the valuations just went up without the earnings going up enough yet. So what's going to happen next year is you'll probably have a valuation compression, even with the market going up, because earnings are going to dramatically go higher.
Okay.
So far, it's been basically increased valuation. Next year, the earnings are going to play catch up to that valuation. So it'll be kind of counterintuitive. It's not interest rates. It's not, NASDAQ getting ahead of itself. It's just simply the way that it works after the first year of an extraordinary move when you haven't had the earnings recovery yet.
Okay, so you're saying that even if the valuations don't expand, it's not going to be a problem for the market overall because earnings are going to explode higher so much. Tony,
correct.
What's the difference, though, in terms of that impact for the market from a returns perspective when we're used to getting huge returns? I mean, the NASDAQ here just powering 80% off the lows. What do we expect then for an earnings-driven market as opposed to a valuation-driven market? Because even pre-COVID, according to Goldman in 2019, 90% of the price of the market moved higher because of valuation expansion. That was pre-COVID. So if we're moving from 2 years of valuation expansion to now an earnings-driven market, what does that mean in terms of what investors should expect in terms of like an annual rate of return?
Yeah, it could be a more muted return, but again, positive. Remember, the market correlates with the direction of earnings. And with interest rates near zero, well, certainly zero for the Fed for the foreseeable future, and you have the long end at 0.92%, there's still going to be that money movement into equities and into risk assets because it's math. You have to get the needed return. If you're a pension plan that needs a 7% return and your fixed income component is giving you under 3%, you can't get there from here. You have to move into risk categories. So even with maybe a multiple that just kind of stays where it is as earnings catch up or even comes down a little bit, it's still an environment where you want to have risk assets on, again, as long as you have access to money. And all the data is suggesting that. So, frankly, I think it's better to have a more normalized environment. Oliver, people forget, coming out of the great financial crisis, the market was up 50% into August, stair-stepped higher into the end of the year. We wrote that note in August of this year that it would be like that. And then you had, a solid run until, 2020. But here's the thing. you had a lot of corrections in there. You had the flash crash of 2010. You had the European debt crisis of 2011 and 12. You had the commodity crisis of 2015-16. So just a more normalized environment where we don't expect up and to the right all the time. We want to take advantage of weakness versus fear it, and not chase excessive strength in a more normalized environment.
Tony, could we get a situation where earnings growth, because an earnings growth driven environment, when we did get earnings growth for a lot of big tech during this period, we got top line explosive growth for some of the most important companies in the market that meant earnings beats. I mean, we're talking billion-dollar beats over the last quarter for the biggest companies in the market. Microsoft, Amazon, Alphabet, all these companies did earn more money. Their earnings did expand. If the market's going to shift to earnings growth from here as being the primary driver, could investors expect a kind of reverse divergence where you've got the Nasdaq underperforming in a big way to the Russell or the value trade? Could we get an environment like that that's basically the flip-flop of what we've seen?
Yes, but it's not because Nasdaq collapses and cyclicals go up. Don't forget that the market is now such a significant form of the market is passive. So when money goes to work in equities, it buys everything based in the indices. And as you know, the weighting of some of the biggest mega cap stocks that are on the Nasdaq have a pretty big weighting in the S&P. So if a lot of money goes in there and it goes passive, by definition, it's going to go in there as well. So I don't think this is a situation like 1999 or 2000. Remember, we had the opposite macro backdrop then. You had the yield curve was inverting. The financial conditions were tightening. Credit was a mess. Liquidity was being drained, not added. So it's the opposite from a macro backdrop. But again, Oliver, I think it's more of a, just like I said back in August, the Nasdaq should underperform in a global growth synchronized recovery with excess liquidity. It should underperform, but not because it's going down significantly, but because it's probably going up a little bit less.
Got it. Okay. Hey, Tony, the potential as a complicating factor nobody thinks is going to complicate anything are, of course, yields. We had the conversation this morning with Andy Brenner about the Fed being accommodative but static versus accommodative and more accommodative with every meeting. Just want to get your final thoughts. As an equity guy, are you comfortable with what you see on the horizon for yields, or do we have to watch that as a potential disruptive point?
Oliver, the Fed keeps looking into the camera, and they keep saying that we're going to print more money. I continue to follow the Fed and believe them. The guys printing the money continue to give us their game plan, and even at the last Fed meeting, it was very important differentiation. They not only promised zero interest rates through 2023, they also indicated QE at the current level through 2023. So that was an addition. It was different than the prior meetings where they just talked about the zero interest rate policy. The guys looking into the camera and the fiscal guys keep telling us they're going to give us money, and they keep doing it. I have no reason to doubt them.
Throughout this time, yields have been steadily climbing, Tony, since August as the Fed has added all this on. Do we need to worry about what happens if we cross 1% and open up the door higher?
That might be one of those things that help create a market pullback, but ultimately it's a steeper yield curve is good for economic activity and bank lending.
All right. Thanks for joining us, Tony. Good conversation and thorough one. Appreciate it as always.
You too. Have a great holiday, Oliver.
Thank you, Tony Dwyer, Chief Market Strategist, for a long walkthrough of the market. Thanks for sticking with us, Tony. Really good conversation to set up the week.